Hey, what's going on YouTube? Welcome back to Tech Conversations. I'm your host Guillermo. It is June 7th. Hope you're all having a great day today. As you can see, another green day in the stock market for me, up $800 or about 0.8% today so far. Looks like things are starting to drop, so we'll see what the rest of the day brings us. Now in today's video, I want to talk about cash secured puts versus covered calls. This is a very common question I get asked all the time. Which one is better? Which one pays more? Which one should I start with? So before I get into that, all I ask is that you guys hit the like button down below and subscribe, guys. It really helps out the channel. Cash secured puts versus covered calls. And so let's go ahead and go over to AMD for this first part of the video. So we'll go to AMD stock here and let's head on over to the options with AMD. I've been selling some puts with AMD for the last couple of weeks. And so what I first want to start off by doing is kind of going quickly through what a cash secured put is and what a covered call is and how they work. So we'll go over to sell. Let's start with cash secured puts. So when would you sell a put? You want to sell a put if, for example, you want to buy a stock, but you want to have more control over how much you pay for this stock. So one thing I like to tell people is don't buy and sell shares, sell puts instead. Because for example, I could go ahead and buy 100 shares of AMD right now for $80.73 a share. But let's say I don't want to pay that much. Let's say the most I'm willing to pay is $80. Well, then I can try to get it cheaper by selling puts. I can go over here to the $80 strike option here. Now I could sell this put. And what this means is that if on the end of the day on the expiration date, which is June 11th, AMD is under $80 a share, at that point I'll have to buy 100 shares of AMD for $80 a share, which is fine because that's how much I wanted to pay for it. And if it's not under $80 at the end of the day on expiration, if it's above $80, then I won't have to buy any shares. Now in return for selling this put, I receive a premium. The premium is going to be under the price here. I'm going to receive 82 cents per share. And remember, each contract controls 100 shares because you're willing to buy 100 shares here. So I'm going to receive about $81, $82 for selling this put. So again, either I'm going to have to buy 100 shares at $80, or I'm not going to have to buy any shares. And in both situations, I get $81, $82. Now, on the other hand, we have selling calls. Now, selling covered calls requires you to own 100 shares of that stock. If I wanted to sell a call on AMD right now, I'd have to own 100 shares of AMD. So I'd have to go ahead, buy 100 shares of AMD, and then I could sell a call. And the way selling a call works is, let's say, for example, I wanted to sell this call. What's going to happen then again, if on the end of the day, on the expiration date, June 11th, AMD is trading higher than $82 a share, because I sold this call here, I'm going to have to sell my 100 shares of AMD at $82 a share. However, if it's $82 or under at the end of the day on the expiration, I keep my 100 shares of AMD. And in both situations, again, for selling this call, I'm going to receive a premium. And again, that's under the price here. I'm going to receive 63 cents per share. There's 100 shares here, so I'm going to receive $63 in premium. So now that we understand that, that's just a quick passage of that. Again, I have more in-depth videos. If you want to go watch those, go ahead. But that's just kind of a quick overview of that. Now that we understand that, though, we can kind of see what one advantage here would be to selling puts versus selling calls. And that would be that by selling puts, this will allow me to get the stock at a bigger discount. Because again, to sell calls, you need to own 100 shares of the stock. I'd have to buy AMD right now, 100 shares at least. That would cost me $80.78. But by selling a put, I could potentially get it even cheaper because I could, for example, sell a put at the $79 strike. And if AMD is below 79 at the end of the day on the expiration, then I'd buy the 100 shares, but at $79 a share, rather than having to buy it right now for $80.80. And then selling calls. So you can see selling puts allows you to get the stock at a potential discount. Now, the other thing that a lot of people don't realize, but this is very important to notice, and we don't have to worry about this on Robinhood because Robinhood doesn't have any commission fees, but there's a lot of brokers that do. I sell calls and puts on other brokers that have commission fees. When you sell a put, that is just one transaction, right? If I were to sell this put at the $80 strike, I would sell that put. I'd most of the time let that expire. I would receive my premium of $78. That's it. However, to sell calls, there's going to be two transactions, because the first thing you need to do to sell a call is you need to buy 100 shares of the stock. I'd have to buy 100 shares of AMD. There's one transaction. And then I'd go ahead and sell my call. There's the second transaction. And again, depending on what broker you're on, they could be big commission fees, right? And so again, if your broker has commissions and you're doing two transactions, it's going to cost more. So selling covered calls can cost more than selling cash secured puts because there's more transactions involved. Now let's talk about one way that selling calls is actually more superior than selling puts. So again, let's pretend I wanted to sell this put here at the $80 strike. The most I'm going to make, no matter what happens, is going to be the premium I receive, $77. And so selling puts, the upside potential is limited to the premium you receive, because again, this is the most I can make by selling this put, $77, $78. However, if we take a look here and let's say we wanted to sell a call instead, let's say I go over to the options profit calculator and I go to the covered call calculator under basic here. Let's take a look at what the most we could potentially make here is. So let's say we'll do again AMD here. So let's say instead of selling puts, I wanted to start by selling covered calls, because I think selling puts, it has limited upside potential. So I could, go ahead, get the price here. So let's, pretending I'm buying 100 shares right now and then I'm selling my call. Well, I could potentially sell a call, let's say at the $85 strike. I'm only going to get $13 in premium, but if we take a look here, right, what's my max return here? $437. If on the expiration date, AMD jumps up all the way to $85, I'm making $437 here, right? And if I put up my strike here up more and AMD gets that strike, it's going to be even more, right? So I could potentially go all the way to whatever this allows me to go to, 115 looks like, and calculate that. Now my max return is $3,425, right? So potentially there's unlimited return here because, depending on which strike you choose, and if AMD goes all the way up there, you could make a lot more profit, right? So as you can see, selling calls, this has more upside potential than selling puts, because when you sell a put, all you have is basically the premium you receive. That's the most you're going to make. However, there is one thing we need to recognize here though. When it comes to downside protection, selling puts is going to be the best bet, right? Because again, if we take a look here, if I sold a put at the $80 strike, right? Let's say that on the expiration, at the end of the day on expiration, AMD is at $80, exactly $80. I'm still making $77. I'm still walking away with $77 and I won't have to buy any shares. However, in this situation, right, yes, there's potentially more upside potential, but what if here on expiration date, the stock is at $80? Well, we can take a look here at, how much or what other losses or gains would be here. If it was $80 on expiration in this scenario, what does this say? We're actually going to be down $75. Why? Because selling puts has more downside protection. Again, over here, if on the expiration date, AMD is exactly $80, we're still walking away with a $77 profit. In this scenario, if it's at $80 on the expiration date, we actually are going away with $75 loss so far. So again, selling puts, upside potential is limited. Selling calls, it has more upside potential, but selling puts has a lot more downside protection. So you kind of have to figure out which one is best for you when it comes to that. Now, the other big thing that we need to recognize here is if you're a dividend stock investor, right? That is, you invest in dividend stocks. You really don't make much of your profits from, stocks going up in value and then selling them. You make most of your income from the dividends that you receive from stocks. Well, then it's going to make more sense for you to have to sell calls, right? So for example, if I go to Microsoft here, I have 100 shares of Microsoft. I've had these for a long time. I've been selling calls every week. As you can see down here, I have a dividend pending from Microsoft, $56. Why? because I owned my 100 shares of Microsoft and I was selling calls on them before the ex-dividend date on Microsoft. And so because of that, I qualified to receive the dividend from Microsoft. If I instead had been selling puts on Microsoft, I would not be receiving any sort of dividend. And so if you're a dividend stock investor, you need to own the shares. You need to be holding them to qualify for the dividend. So if you're a dividend stock investor and you want to sell options, your real only option will be to sell covered calls then, right? Because you have to have the shares to sell the calls, or not sell the calls, to get the dividend. And so since you already have the shares, it's going to make more sense for you to go ahead and sell calls on those shares, right? So if you do have the dividend, if you want to earn dividend from stocks, it's going to make more sense for you to sell covered calls, because if you sell a put, you're not going to receive any dividend from that stock. So ultimately, as you can see from what we've talked about here, there's going to be a lot of similarities here. There's a couple of differences like we just mentioned. And ultimately, in my conclusion, unless, again, one of these things that I talked about applies to you, I would start by selling puts, right? So for example, if I go to DKNG, DraftKings, I'd like to own DraftKings. I'd like to own it for cheaper though. That's why I'm selling puts on it, right? $47.50. If I can get it for $47.50 a share, I would be fine with that. So I would start by selling puts, unless, again, one of these things I just talked about applies to you, or if you already own the stock, right? If you already own the stock and you're just learning about options, probably makes most sense for you to start selling covered calls. There's no sense in you selling your stock and then going over to selling puts. I would just start with selling covered calls if you already own the stock. But I would start by selling puts. And then remember, by selling puts, you're eventually going to be assigned. There's going to come a day where you get assigned. You have to buy the 100 shares at whatever strike price you chose. After that happens, remember, you can just switch on over to selling covered calls at that point, right? If you prefer selling covered calls, don't worry. Selling puts, you're eventually going to get assigned. Once you're assigned and you have those shares, you can go over to selling covered calls. And then again, by selling covered calls, you're eventually going to be assigned. You're eventually going to have to sell your shares. It's going to happen. And once that happens, again, you can go over and start selling puts again. This is called the wheel strategy. This is why this is a very powerful strategy, because it kind of just circles around, and it's almost like you can almost not lose. I mean, you can lose, but it's very hard, especially if you're doing it correctly. Okay, so ultimately, as you can see, a lot of differences, a lot of similarities. But again, unless one of these scenarios I talked about applies to you, I would personally start by selling puts. But let me know in the comment section below which one you prefer to start off with, or just to kind of utilize in general. Which one you think makes you more money in the comment section below. So if you have any questions, feel free to leave them in the comment section below. Check out the Discord, link to it in the description below. I hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.